Hey guys, what's up? Welcome back to the channel. In today's video, I'm going to be doing a crash course to teach beginners how to get started with investing in 2020. So I've designed this video for complete beginners who are completely new to the stock market, and let's say you want to get invested in 2020. Now this video is going to take you from complete beginners. We're going to explain what the stock market is. I'm going to give you guys some tips and tricks along the ways, and by the end of this video you'll actually be ready to invest in the stock market. And if you stick around to the end of the video, I will show you guys how you can go as a complete beginner who knew nothing about the stock market prior to watching this video to actually investing with confidence by the end of this video. So stick around for that. Alright, so the first thing we're going to talk about this video is what are stocks? What are stocks and how can you make money from stocks? Alright, so a stock is basically an ownership of a company or a share. The ownership of a company is divided into different shares, and these shares are worth money. So when you buy a stock, you're essentially buying a share, or you're buying like part of the ownership of the company itself. And we can go into Google here, and you can actually type in the price of any stock you want. So let's say you want to find out how much a Google stock was worth because you're interested in buying it. You could go to Google and type in Google stock. And what this will do is this will bring up this little graph here, which give you a bunch of numbers you probably don't know what they mean. But the only one you really need to pay attention is this number up here, which will give you the actual price of this Google stock, which is at a whopping 1,361 American dollars. And you can do this for any stock you want. So let's say, for example, you want to check out the price of Microsoft. You can go to Microsoft here, Microsoft stock. Once again, gives us the price, $158 American. Now, one thing I want to point out right off the bat is a higher stock price doesn't necessarily mean that the stock is better or anything like that. It can, and it usually does, but not always. So just kind of keep that in mind. Just because a stock is priced higher than another stock doesn't mean that it's better. So I just want to point that out right there. So there's two essential ways you can make money in the stock market. You make money by buying a stock at a low price, as you can see on the graph here. If you bought Microsoft in the low 90s, over time up until 2000, that stock would have ridden up slowly over price. And depending on how many shares you bought, like if you bought shares for about $20 here, let's say you bought 10 shares for 20 bucks, you know, if those shares went up, let's say $10 at the end of the year, you'd beat up, I guess, $200 or something like that. So that's basically how stocks work, and that's how the main way people make money with stocks is you buy a stock, and then over time, the stock market generally overall tends to grow, right? As long as you're investing in good companies. As you can see in this Microsoft little graph here, Microsoft stock just over time, you know, it goes down a bit, but it goes up and it goes down, but over time it eventually goes up here. You can see if you did invest in Microsoft way back in the 90s and early 2000s, you'd be doing pretty good right now. Now, the other way you can make money with stocks is actually make money with dividends. Now, dividends are one of my favorite ways to make income from stocks, as well as other people, because think of dividends as, you know, the company basically paying you a share of the profits for investing in their company, right? And in the beginning, your dividends will be pretty low here, but over time, as you invest more into stocks and as you grow your stocks and your stocks grow in value, these dividends start to add up. And if you're really smart, you can take your dividends, reinvest them back into your stock, and then those dividends will go up in value, and they'll pay you more dividends, and that cycle will just keep going and going. This is called compounding interest, and it's a very strong thing. As you can see here in my portfolio for 2019, my dividends over the year, you know, slowly rose up as I kept putting more money into my portfolio, and they went back into the stocks, and you know, you can just see it goes from there. It creates this big snowball effect that over time the dividends grow. And at the end of the year, you're looking at a total return of your stocks growing up as well as your dividends. So those are the two main ways you can make money with stocks. In a nutshell, that is how you make money with stocks. If you guys are interested, I actually posted a video a couple days ago. I'll link to it in the description of this video that goes over my 2019 stock earnings. Check that video out if you want to see more how I actually made money with stocks in 2019. And the next thing we're going to talk about is how to pick stocks. Now here's the funny thing. I'm actually not an expert on picking stocks, and if you are a beginner to the stock market, I highly recommend actually that you don't go and start picking stocks right off the hop. And you might ask, like, well, how are you supposed to know what to invest kind of thing? And we'll talk about that in just a second. But the problem with picking stocks is if you pick a stock and then that stock goes up, you know, it might go down, and if you're all invested into one stock, you don't have much diversification. And we can fix that problem by investing into index funds and ETFs. So what are index funds and ETFs? Well, they're basically a collection of stocks altogether. You can buy into an index fund or an ETF for a share price of, let's say, $100. Now that ETF might have a collection of anywhere between 10, 50, 100, or even thousands of stocks. So when you put that, let's say that $100 into that ETF, you're buying a share of all those stocks together. So as the stock market rises over time, you're more likely to get an increase in a profit, and it kind of balances things out and diversifies your portfolio a lot than investing into maybe just one or two or three or four stocks. And the cool thing about ETFs is overall, historically, they've performed pretty solid. You might have heard of the S&P 500. It's one of the more popular ETF or indexes out there in the market right now. The S&P 500 is the top 500 stocks in the US. And if you look at the yearly returns here, on the left side I got the calendar year, on the right side we got the overall percentage for that year. All these numbers in the middle, we don't need to care about. This is the overall growth for each year. Overall. So if you invested your money into the S&P in 1972, you got a 15% return. That's pretty solid. And you can see here that another point I want to point out is that every single year you're going to get ups and downs, and every single different stock, every different ETFs has its different ups and downs. You see with the S&P, there's some years where it goes up quite a bit, but there's also some years where it goes down, and this happens in stocks. But if you're investing into long term, which you should be doing if you're getting interest in the stock market, you're going to get those ups and downs. But if you keep your money in for the long haul, you're going to see that over time, the positives just outweigh the negatives. In fact, the S&P 500 has an average yearly return of 10%. So if you took the average return of every single year, got rid of the pluses and the minuses, you get a 10% average, which is pretty solid for stocks. So imagine growing your portfolio by 10%, over a 10-year period. That's pretty solid. And again, you can see that the S&P 500 is still performing pretty solid today. It is a collection of a lot of stocks. Another example here is VTI, Vanguard Total Stock Market. This is another American-based fund. You can see here that this ETF, which you can buy for, I think it's about $100, has 3,561 stocks in it. Let me repeat that again. 3,561 holdings. That means that when you put that money in, so let's say you have $10,000 invested into VTI, that one ETF, you're getting all these different stocks in here. And you can see these are pretty solid stocks. So Microsoft Corp, Apple, Amazon, Facebook, Visa, all these cool, these stocks that have a history of going up in value. So I think, if you're going to put money into an ETF or an index fund, it's one of the smartest things you can do. And it's as simple as just sticking the money into the fund, and then that's all you have to do. There's no researching, there's no trying to figure out which stock is the best stock and all that kind of stuff, or worrying that maybe you picked a bad stock kind of thing. I think you can feel pretty good about sticking your money into ETFs and index funds, because I think over time they perform pretty solid. Now you can search for your own ETFs and do some little market research and see what a good ETF is if you want to kind of build your own portfolio, and that's something I'm doing myself. In fact, I actually have a video series. Once again, I'll link to that in the description of the video if you guys want to check out. I'm actually building a dividend-based portfolio by picking my own ETFs. So check that out, as that's a different approach, and I'm kind of like learning how to pick my own ETFs and stuff like that. But for me, my first year in investing in 2019, I actually used what is called a robo-advisor. So you might ask, what is a robo-advisor? Well, it's basically an online platform. I'm on Wealthsimple right now. There's a lot of different popular ones out there. So just you can look around and stuff like that, but I'm using Wealthsimple. And the thing is, you set up, so you make an account and stuff like that. It's super easy to do, and then they ask you a risk assessment. So they ask you, like what when are you going to use your money? How much money can you put in? Blah 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 kind of thing. And then what they do is you put your money in, and they pick some ETFs for you. So it's pretty simple to do, and it's a great way for beginners to get started with investing without worrying about all the complications of picking stocks and ETFs and whatnot. And once again, to show you guys how this works, this is my portfolio that Wealthsimple picked for me. And again, you can see these are some pretty solid ETFs. So there's a lot of diversification and stuff like that. I'm actually going to show you how this works firsthand, as some of my ETFs perform better than others. So you can see here I have US stocks, I have international stocks, I have emerging stocks, I have global stocks, I have Canadian stocks, some more US stocks, and then some bonds at the bottom here. So all these different ETFs, so I essentially have about 6 different stock ETFs, and my portfolio is 90% stocks and 10% bonds. And you can see here that all I had to do with this robo-advisor is stick money on the platform, and they decided what to do with it, kind of thing. So they kind of do this balancing act sort of deal, and you can see the percentage of all these different ETFs. And on the right side here, you can see the different shares. I mean the shares and the performance. Sorry. So you can see here in 2019, I had a performance of my VTI stocks grew by 6.4%. That's my American stocks, pretty solid. My foreign stocks grew by 4.4%. Not too bad, not an amazing year, but not too bad either. My emerging stocks actually didn't do that great. They had a negative 1%. So they're probably going to pick up next year, which is fine. And then global stocks, we have a 1.1%. Again, not the best, but definitely not horrible. And then Canadian stocks at the bottom here, 3.1%. And then my U.S. hedged funds stocks, which for whatever reason, grew up by 9%. So all this kind of balances out. So even though my EEMV ETF, which didn't perform that great, it doesn't matter because these other ones kind of balance things out. So if you have a really good year, your ETF portfolio will be pretty solid. And if you have a bad year, things tend to balance each other's out. If you put all your money into EEMV, you'd be sitting at a -1 loss, which probably doesn't really matter because over time that would probably rise up anyways. But it feels good to have like a portfolio that, your lows are low and your highs are high, right? And it guarantees that if for whatever reason you need to take money out of a portfolio or something like that, at least you can feel good about taking money out when you're doing pretty good, right? And it just keeps you going kind of thing. So I always highly recommend that you put your money into like ETFs and you pick a handful of them. But if you use a robo-advisor, it does everything for you. And this is why I recommend you do it for beginners. So if you're a complete beginner, here's what I recommend you guys do. Get a robo-advisor, start putting a small chunk of money away, maybe like $100 a month or $100 a week. The more money you can put in, the more money you will make. But keep in mind that this is money that you're not going to be spending. You're going to be holding for a long period of time, right? So I'd be maybe in the beginning be a little bit conservative. Then after a little while, you get a taste of investing. You can go up from there. But yeah, pick a robo-advisor, start putting some money in, and then maybe after a couple months, after you've kind of read up on stocks, you've kind of looked at different things, maybe you've watched some videos on YouTube and stuff like that, and you educated yourself, then you can start looking at ETFs. And then maybe once you get comfortable with picking some ETFs, you can have maybe a small little play portfolio where you can invest in individual stocks with a small percentage of your income, if you want to do that kind of thing. And I recommend for beginners, that's probably the best route to take, because then you're not screwing up, and you can actually see. It's important to see how the stock market works and get used to those ups and downs, because you're going to get ups and you're going to get downs. So when your portfolio is small in the start and you see those downs, it gets you used to the fact that, you don't have to really worry, because as long as you have a well-diversified portfolio, it will go back up over time. Alright guys, so that's it for this video. I hope you guys enjoyed it. I want to also remind you guys that patience is the key to investing in the stock market. You're not going to get returns or huge returns over a couple months. You might, but eventually you got to understand that over the course of a couple years, your stocks might go up and down. They might go down. They might go up, kind of thing. But over the long haul, you will start to earn income and see that money coming in. So patience is the key here. Like anything, you can make pretty good money with the stock market, but it just takes time. So that's it for this video, guys. I hope you guys enjoyed it. Let me know what you think in the comment section. Please share it with your friends and give it a like if you enjoyed it. And remember to subscribe to the channel if you want more investing type videos for complete beginners. That's it for today, guys. Thanks for watching, and I'll see you later.